Welcome to TradeSense, where Windward brings together the brightest minds in global trade, maritime, and AI to break down the biggest developments shaping our industry. I'm Michelle Wiese Bockmann, Senior Maritime Intelligence Analyst at Windward, and in each short episode, we go beyond the buzzwords to deliver insights that matter. Today, we're diving into EU and UK sanctions on Russia with Pamela Munger, Head of Market Analysis Europe with Vortexa. Vortexa is a London-based commodities tracking analytics firm and a valued Windward partner. Hi, Pamela. Thanks for joining us. How are you doing?
Hi, thank you. Thank you for having me. I'm doing great, and I'm really excited to talk about the latest EU and UK sanctions packages and what impact we're seeing in shipping.
Let's get into it. These latest packages on Russian oil and shipping did a lot more than sanction some ships, which is what we've seen previously. They targeted fleets, but also flags and fuel. And it really is a significant departure in strategy. So walk me through some of the key elements.
Well, the EU managed to pass that 18th sanction package, which includes three main points. The first main point is the 105 additional vessels that have been sanctioned. There's also probably this one, the most significant change, is the change to the dynamic price cap, which is now 15% below the average market price versus a static price cap of $60 per barrel. And the third main point is the banning of oil products, so clean products, refined with Russian crude oil, which is effective January 2026.
Yeah, they're big moves, aren't they? Especially the price cap, because the price cap, for those that aren't quite clear, it's a mechanism that was introduced, I think, December 2023, and it means that Western marine insurance providers, so you've got your charterers, ship owners, insurers, oil traders, financiers, you can't provide any services for any vessel exporting oil to a third country unless it is below that price, which is until this week had been $60 a barrel. For the last couple of years, this price cap's been imposed. The UK's followed suit, and they followed through with sanctions on Natasco, which is the trading arm of Lukoil, which is the second largest producer. And also, I think the EU sanctioned one of the Vadna refinery, which is 49% owned by Rosneft. So, quite a big deal. What does it mean for the oil and shipping markets, Pamela?
I think that the two-prong approach to the price cap will likely, like I said, have the biggest impact in the sanction package. And why is that? I think it's the impact to the Greek operator behavior mostly. And why would that be? I mean, there's a lot of unanswered questions about how the price cap will be followed. And the Greek operators have been essential to facilitate the Urals or the Russian crude exports since the Urals fell below the price cap in early February following the January OFAC sanctions. So just in June this year, these Greek operators actually lifted 43% of all Urals exports, and that's the second highest level recorded since the price cap started. So if these operators were to leave the Urals trade due to fear of EU sanctions, Russia would then have two options, it seems. One, to either find new vessels, which is difficult with so much tonnage already engaged in other OPEC market trades, or offer Urals a steeper discount and face further debt and revenue in order to continue to utilize those Greek operated vessels.
Yeah, so that's been one of the probably least understood mechanisms about the trade, is that these Greek operators have been able to legally lift, especially Urals grade, because the global price has fallen below the cap. But of course, by cutting the price down a further 15%, there's going to be a tonnage shortfall. And of course, we've got both the UK and the EU sanctioning 100 vessels plus over the last week. Both of them now have in excess of 400 vessels total sanctioned. Where is this tonnage shortfall going to come from?
Yeah, that's a good question. And the exodus of any of the Greek operators from the Russia trade could exert some supply side pressure on the mainstream Aframax and Suez markets. So it's a really interesting one to watch.
Of course, not all sanctions are equal. We've seen the EU and the UK sanction vessels which have continued to trade. So that's another dynamic because the US has not agreed to lower the price cap. So now we're seeing what I would say is a divergence in sanctions approach between, key members of the G7.
One of the questions I think will be how will it be enforced? What will we see going forward, possibly from the US in response to this movement by the EU sanctions and the UK?
Well, I think there's that bill in Congress now in the Senate that everyone's watching very closely. The US hasn't really taken any significant sanctions action on Russia since the Biden administration's January designation of hundreds of vessels. So now we have this very, very strange period of enforcement and compliance. I'm particularly interested in how on earth the EU is going to track and enforce the requirement that petroleum products must not be derived from Russian oil. I mean, this is making things really complex, isn't it?
Yes, it is. I mean, what's going to be very interesting, though, is to see, of course, that enforceability. And we're talking January 2026. So we still have quite a bit of time in terms of when that third element of the sanction package comes into force. Now, overall, we do think that aside from the questions about the enforceability, we do think that, in particular, into Europe, we're really looking at flows from India and Turkey. Those are the countries that take in large volumes of Russian crude and refine it. However, shares in EU of imports of clean products are 6% for Turkey and 5% for India. And the combined shares for diesel are 22% and for jet 14%. So what does this mean? This actually means that if there's a reduction of clean product flows from Turkey and India into the EU can continually look towards the Middle East to fill this gap and leave India and Turkey to export those volumes, especially diesel, which is really the main impact, over to the Mediterranean instead. So we don't see it necessarily having a massive impact for the European perspective. And again, there's still a lot of questions around that enforceability, asking for the certificate of origins to make sure those refined products have been refined from crude other than Russian crude. And also to mention that India and Turkey, they don't only take in Russian crude, they do take in other crudes as well. So there's a very real case where the crudes can be blended. So again, it's going to be difficult to certify that those clean products have not been refined from any level of Russian crude.
Yeah, things got really difficult all of a sudden. If it wasn't already complex for the oil and shipping industry, I think, this has really doubled down on how difficult it is. I'm going to leave it there. I think really everyone will be waiting for those FOQs, the frequently asked questions that usually arise over these big moves. And, I think both the EU and the UK are going to be, the regulators there are probably going to be dealing with lots of inquiries in coming weeks. That's it for this episode of TradeSense. Thanks for joining us, Pamela, and unpacking the impact and what these sanctions mean. If you've found this episode informative and useful, please share this video and follow Windward for more insights, and stay tuned. We've got another expert conversation coming soon.